Good evening, everyone. Thank you for joining for the webinar. Let's start the presentation. We have Sebastian from the Equiton Group, where we would be discussing how you can invest in real estate with as low as $5,000 up to $10,000 on the lower side in different funds and can still get a great returns of around 8% to 16%. So I'll leave the stage to Sebastian. Sebastian, please let our
I,
clients know about Equiton.
I appreciate the introduction, Harshit, and thank you to everybody that joined today. What we're going to be doing today is just learning about a different alternative to real estate investing. So thank you once more time for taking the time out of your day to join me here. We'll break it down for the people that don't know about Equiton. We are a private real estate investment firm. We focus in the private sector, and what we'll be talking to you about today is um, how we got started, right? Where we come from. I'm going to talk to you a little bit more about the space that we work in, the industry, and then we'll dive into all the investment options that we have available and how they might be able to suit what you're looking for as well. All right. So I mentioned before, we are a fully integrated investment firm. To give you a background, we started back in 2015. Now, we started the company with three founders. At that point, there was an initial $1 million investment that allowed us to acquire our first property in Stratford, Ontario. Now, fast forward all the way till 2024, we now manage over $1 billion in assets. We've now increased our employee size to over 195 people across Canada. So in all aspects, we've been growing and quite exponentially, really. As you can see from this next slide over here, the growth has been in a great trajectory, right? And last year, in the fall of last year, we hit our $1 billion market assets under management, which was a great milestone for us. But before we dive into anything else, I want to highlight that the space that we work in is the private space, right? Now, there's a few advantages with that. What you're getting in a private investment is a lot more security, less volatility. Now, unlike a public investment that you might be familiar with, um, talk about your stocks, mutual funds, cryptocurrency, for example, those are all investments that are on an exchange, right? Whether it's the NASDAQ, TSX, right? With those investments, you are getting a lot of volatility because ultimately, at the end of the day, there's a market of buyers and sellers that are driven by emotion. Not sure how familiar you guys are with any of those investments. An example, if some good news comes out today, markets can rally. But in that same manner, if something bad happens in the market, although companies may be performing well, they are still going to get affected, right? So that's the downside of the public side. What we have here at Equiton in the private industry, on the other side of the spectrum, we have a much more robust investment. Now, we're not listed on any stock exchange. So when you're investing in a company like Equiton, you're doing directly through the company. Now, there's a bunch of benefits with that. The main one, like I mentioned, is that we're not correlated to the movements of the public sector. That allows for a much more controlled investment, but more importantly, a much more consistent performing investment as well. And that's really what a lot of investors look at, right? The consistency of the returns, right? Now, I'll give you an example here and providing you with this chart. That's going to be highlighting the consistency. Now, this chart is showing the apartment index, right? As you can see in the yellow line. Since the 1980s has been tracked, and as a highlight, we've been experiencing some major financial crisis, right? We saw what happened with the tech bubble. We saw the global financial crisis of 2008. More recently, we saw COVID, right? A new market that we've been seeing. But across all of that, as you can see, the public sector has been volatile, right? However, the private apartment sector has been very consistent. Even in those times of volatility, we still been able to provide positive returns to our investors. And that's really what I want to highlight with that. Now, one thing to note with the private sector, although you might see that it sounds very good, right? Positive returns, consistent returns. There is a downside as well too, just like anything. It comes down to liquidity. Now, comparing it back to the public investment examples that I gave you earlier, if you were to buy or sell a stock, it could be done very, very easily, right? You go off into your brokerage account, offload thousands of dollars within a few clicks of a mouse. With the private sector, specifically because we're dealing with real estate, you can't offload a $1 million, $10 million property very easily. So because of that, we don't have that same liquidity as a public investment like a stock would, right? I want to highlight that we're a long-term investment. Depending on the option that I'm going to be presenting to you today, you can expect a minimum holding period of 3 years. So as long as you're comfortable with a 3-year holding period, and for the most cases, if you're familiar with real estate, that is the nature, you'll feel right at home here with Equiton. Perfect. Now, moving on, now that I talked to you about the private versus publics and its benefits, I'm going to provide you with the actual suite of investments that we have available for our investors. Now, we have something that's going to please all types of investors. Whether you have a different risk appetite or long time horizon, we have a little bit of everything. Now, this is the lineup and our suite really of investments. At a very high level, what we're getting here is two things. We have the investment styles to the left over here. These are our fund style investments. Now, what you're getting with a fund style investment, you're getting two main things. The first thing is diversification, because a single investment that you make will be diversified among different assets. And the other benefit of a fund style investment is that you are getting cash flow. So if anybody that's looking for cash flow, the fund style investments might be very suitable for you, right? Now, as you can see, the returns range anywhere between 8 to 16%, depending on the investment, right? And if you are looking for something that's going to give you more returns, right, with a higher risk as well, we have our development offering. Now, with the development offering, what you are getting there is not a diversified investment, but a more concentrated investment. Now, your capital will be used for the development of a property. Now, although you are getting higher returns, you are locking in your funds until the completion of the projects. Unlike the funds where you can access your funds at any given time, with the development, it does have a higher time horizon. Depending on the project, it's usually a 5-year time horizon. But you have to understand that you're locking in your funds. Now, all great options. It all depends on what your strategy is. What is it that you're looking for? Are you looking for something that's going to provide you more income? It could be the funds. Are you going to be looking for something that's going to be higher returns? It's going to be the development. And we also have our income and development fund right in the middle, which gives you a little bit of both. It's going to give you some cash flow component as well as some growth component as well, right? Hopefully you guys were able to take in that high level overview. Well, what I'll do is dive into each and every single one of these options and provide you with more information. Starting with our apartment fund, this is the flagship fund. Now, this is the fund that our company got started with back in 2015. We've been able to grow this fund quite substantially to over 10,000 investors. Now, the apartment fund here has a very simple strategy. We buy and hold multifamily rental properties. Now, part of our strategy is to look for properties that could be underperformed. Oh, yeah. So we look for properties that could be underperforming, properties that could be maybe mismanaged or don't have the resources to continue to improve them. And we look for them at a great valuation, right? Now, once we acquire those properties, we're able to improve them, right? Get renovations that need to be completed. We're able to improve the efficiency of how they're managed, right? Ultimately, optimizing those properties. So we're not looking for properties right at the peak, like brand new properties where we might not be able to optimize them. We're looking for properties that need that extra resource, right? So we use our expertise, the capital that we have, all our resources to over time be able to increase the value of those properties but also increase the revenue that they generate, right? Now, you as the investor are part of that strategy. Now, the capital that you use will be diversified and it will entitle you to a share of that fund. So the benefit there is that you're diversifying to every single one of the properties that we have. You're not just focusing into one property. So that is really the strategy. Very, very simple strategy for anybody that's a real estate investor. It's pretty much the exact same thing, but we're doing it at a very large scale. On some of our properties, on average, are worth $10 million. And I'll dive a little bit more into the type of properties that we have available in our fund as well. Like I mentioned before, the growth has been quite great. As you can see, this is the growth of the assets under that fund. In this fund specifically, we're very close to that $1 billion mark. We have approximately 970 million in assets under management currently. And as you can see, as we've been able to grow the fund, acquire new properties, we're obviously also increasing the unit number in the fund as well. So currently we have approximately 2,700 individual doors in the portfolio. Now, you might be asking, where is this portfolio located, right? Now, as you can see from this map, we have very strategic placement into these properties. Now, as you can see from the map, we have a lot of them in the southwestern part of Ontario, right? We go as west as the Chatham area and as east as Kingston. And there's a few reasons why. Maybe a lot of people can relate, but Ontario is ultimately the economic capital of Canada, right? This is where the biggest demand for housing is and also the biggest opportunity. And that's the reason why we focus in Ontario. Not only that, this is also our background, our backyard, essentially, right? Starting from the executive team, all the years of experience in the industry has been in the Ontario market. So we're able to use the resources, the connections built over years to benefit from that. The other thing I would mention is that by having properties within close proximity, we're able to use economies of scale. Now, if we had properties scattered all over Canada, they would have to all be under contracts with landscapers, electricians, plumbers. By us having properties within close proximity, we're able to use the exact same contractors, right? For the most part, the exact same plumbers are going to be looking at all our properties. That's going to allow us to lower our costs as well. Now, the mandate for this fund does allow us to invest all over Canada, and we are planning to do as we continue to grow, right? Continue to have that strategy of being close to other major cities. We had our first acquisition in the west side of the country back in 2022. So we have now 2 properties there, and the outlook is to continue to acquire more properties in the next quarters. And the benefit for you as the investor here is that you're going to be exposed to all new properties and all new acquisitions within that fund. So very, very hands off on your end. Equiton's really doing all that work for you. Now, the type of properties that we acquire here, keep in mind, these are medium to high density properties. We're not looking for a single family home, for example. We're not looking for a duplex or a triplex. These are usually high-rise apartment buildings or full townhouse complexes, right? And I'm going to be giving you an example of the properties that we acquired back in 2023. We did have 2 acquisitions. Obviously, 2023 wasn't the best year for acquisitions, right, due to the market that we saw. But however, we were able to finish off the year with some acquisitions. First one that I'm going to be showing you, this is a 9-story building that we acquired in London, Ontario in the fall. I believe it was in October of 2023. And we also acquired a property in Brantford, Ontario. So another acquisition that we had just at the end of the year. And this one really made sense because we owned the sister property right in front of it. And when it became up for sale, the logical thing to do was to acquire that property as well. So hopefully this gives you an idea of the type of assets that you'll be participating in. Now, the benefit for you as the investor, right? What is it that you can expect to receive being invested into this fund? Now, we are targeting an annual return of 8 to 12% per year, right? And that is very competitive. And the reason, and the way we split this return is in two ways. Approximately 6% of that return gets provided to our investors as monthly distribution. Think about it as a dividend, or even easier, as rent payments, right? If you were to compare this to a traditional real estate investment strategy, approximately 6% is what you can expect on a monthly basis. The remainder 2 to 6% is coming in the form of capital appreciation. Now, that will get realized once you sell your position, essentially, right? All that capital appreciation throughout the years of you being invested will be realized once you sell it. For you, right, there's two options. You can receive those monthly distributions. Let's say you want to have that paid out to your checking account. Those distributions get paid out on the 15th of every month, just like clockwork. But if you're an investor that doesn't need the monthly distributions right now, you can actually reinvest them back into the principal for it to continue to compound over time. So we have those two options that are very flexible. I have some clients that are closer to retirement that want to supplement their income. They have those distributions reinvested. But if you're a younger investor, maybe you want to use the compounding effect to your advantage, that is an option for you as well. The main thing that I would like to highlight with the returns, although they are very competitive, is one more time in the fund that we have provided here, they are very consistent. I'll show you with this graph since an inception, right? Let's say you had invested with us back when we first started, 2016. A $100,000 investment would be over $195,000 to date. And the main thing here is that consistency, that upward trajectory, right? Usually with a public investment like stocks or mutual funds, you might see a big swing, right? Depending on the investment or the year. However, what you're getting at Equiton is a robust investment that even, I'll give you an example, in some of the darkest years that we saw in the pandemic, right, where 2020 was a very rough year for the public sector, we still were able to provide our investors with positive returns. And as a matter of fact, we have provided over 96 months of consecutive positive returns to our investors. And I just want you to take that in, right? There's not a lot of investment vehicles that can provide you with those type of returns. And now, lastly, before I close off this apartment fund, I just want to give you an example of a case study, so you understand really everything that I talked to you about, right, in the strategy here. I'm going to be presenting to you 125 Wellington Street. Now, this property is very, very special because it highlights what we do. Now, we acquired this property back in 2021, and we acquired it off market, right? So we found a private seller. It wasn't owned by any company. It was an older gentleman that owned this property. And due to lack of resources, he wasn't able to maintain the property. And when we went in to look at the property, we saw that the top level, so the penthouse units, were vacant. Now, the reason why the units were vacant was because there was leaks on the roof, and some of the units were flooded, unlivable, essentially, right? Now, if you understand, the penthouse units are the ones that generate the most amount of revenue in any apartment building. And since they did not have those units operating, they were missing out on a lot of revenue on a monthly basis. Now, the owner essentially wanted to get rid of that property, and that's when we were able to acquire it at a great valuation. So we acquired it for approximately $54 million. Now, what happened next is we were able to fix up the top floor. There was no structural damage or anything serious. It was mainly all cosmetic. Once we were able to fix that top floor, we also noticed that in the main floor, there was a lot of administrative offices, right, that we saw could have been more potential. Now, with those offices, we renovated them into operating units. As you can see from the pictures on the top there, we were able to create value by using that office space into now income producing units. And to bring it all home, after we appraised the property, so approximately 2 years later in December of 2023, now that property stands at $91 million. So one more time, that is where our expertise comes into play, right? Because not only are we acquiring the right properties, but we're also executing the right strategies as well. Ultimately, it is to maximize the value of the property, right? Continue to increase those revenues, because the value of the properties is what directly impacts the value of the fund, hence the value of your investment. So hopefully you guys are able to take in how we're creating value to our investors. To close it off, I'm just going to summarize everything with the apartment fund. This apartment fund, one more time, very simple strategy. We're buying and holding multifamily real estate. We have a targeted annual return of 8 to 12%. We also have the monthly distributions that can be approximately 6% and the capital appreciation. Now, this investment and all of our investments that I'll be talking to you about today are eligible for registered accounts. So you can use a TFSA, RSP, LIRA. You could also make a cash investment or a corporate investment, depending on what your situation is. And the minimum investment here is $25,000, making it very approachable, comparing to, let's say, buying your own property, right? You need a bigger down payment for that. This is a way for you to still diversify into real estate without having that big upfront down payment needed. Perfect. So that's what I can talk to you about with the apartment fund. The next option that we'll be talking to you about is the income and development fund. Now, that is that middle option that I talked to you about earlier today. Now, with the income and development fund, structurally, it works the exact same way. We're raising capital from investors and we're deploying that capital into assets. However, you're getting exposure to 3 different asset classes here. With the apartment fund, we solely focus into apartment buildings. With the income and development fund, now you're getting access to commercial properties. You're getting exposure to private lending and development. All of that is built into one fund, right? So this is a great way for you to diversify to different asset classes that you may not have access to or have the experience to do so. Now, when it comes to the fund, it is still going to be providing you with that income, just like the apartment fund. The reason why we're able to provide that income is because we have our income producing assets. So that income is still going to be approximately 6%, and we're able to provide that to our investors because we are receiving the rent from the commercial properties, but also the interest payments from the private loans that we give out. So those 2 components allow for the income producing side, right? That's 6%. However, this fund does target a higher overall return, which is approximately 12 to 16%. The reason why we're able to target that higher return is because we have those developments being built in within the fund. Now, developments, hopefully you understand, are some of the most profitable real estate investments that you can do. And that is the reason why we're able to have a higher overall targeted return as well. Now, to give you an idea of what type of assets you can expect, right? I talked about having commercial properties. Here, these are the type of commercial properties that we currently have in the portfolio. As you can see here, we have a plaza. This is one in London, Ontario. The fund owns the complete plaza, so it is currently fully occupied. We have 2 great anchor tenants in that plaza. One of them is the Wendy's and the other one being the CIBC, which brings a lot of foot traffic to the plaza, making it very attractive for our tenants as well. Another commercial property that we have within the fund is the the beer store, which is also completed. This is a unique part of our fund because this is one of the projects that Equiton didn't acquire, but we actually developed it. So we built this commercial property and now it is under lease for the beer store. So giving you a little bit of a hint into the development side of Equiton as well. Currently in the fund, we have a development project. So the phase 1, which was the commercial property that's being used by the beer store, Now, the second phase of the project is the townhomes that we're building. So currently, we're building these approximately 96 townhomes in the same lot. What you can expect once these townhomes are completed is a special distribution. So, like I mentioned before, we do have the income producing side coming from the commercial properties, but to be able to obtain that 12 to 16%, that is through these developments. So once we complete these developments, the investors into this fund are going to be profiting from the sale of townhomes. Giving you a little bit more of a breakdown, this is the area of where we're constructing. To give you more information, we are currently under pre-construction sales, right? We've sold approximately 60% of all the units here. We're well underway for construction, and we are expected to be completed at the end of 2024. So you investors in this fund can expect a payout at the end of 2024. Now, the benefit with the income and development fund is that you're going to get exposure to all the developments that we have here at Equiton. Now, we have another development, which is called Vicinity or Cool Condos that it got rebranded to. This project is in the Etobicoke side of Toronto, so the west side. This project is in an 11-story mid-rise. We have approximately 180 units here, and has an estimated target to be completed at the end of 2026. So where we are in this project right now, we've already raised all the capital needed. We're currently finalizing the marketing strategy to launch pre-construction sales. But what I want to highlight here is by you being invested into this fund, you'll also have exposure to this development as well. Lastly, another active project that we have is the development is Sandstone's condo, which is on the 2257 Kingston Road. It's on the Scarborough side, so on the east side overlooking the lake. Here, same thing, mid-rise condominium. This time it's going to be 12 stories, and we have an expected completion date of 2027 for this project. So, as an investor into the income and development fund, you're going to be getting exposure to all these developments that I mentioned to you. And the benefit here is that you can have access to this fund at a much lower threshold. I know some of you might have heard of the $5,000 minimum. Recently, it got updated to a $10,000 minimum. Still very approachable. If some people have some questions on why it got changed, I can definitely explain that to you. But the whole point here is that it is still an accessible investment. Think about it. With $10,000, you can get exposure to commercial properties, private lending, and those developments, right? And one more time, just like the apartment fund, this is going to give you the opportunity to invest with registered accounts. So if you had a TFSA, an RSP, a LIRA, all of those accounts are welcome. Awesome. So we've talked about the two funds now, right? We discussed the apartment fund. Main focus here is apartment buildings. We talked about the income development fund that has a mixture of commercial properties, private lending, and developments. The third thing we're going to talk about, and is our final offering here, is the standalone developments. Now, like I mentioned before, I just want to highlight that with these developments, you're not investing into a diversified fund. What you're getting is an investment into a single construction project, right? Now, the benefit with that is that you can expect higher returns. However, you are locking in your funds until the completion of the project. Now, the project that we currently have for offering and available for you to invest is 1099 Broadview. Now, this project is an exclusive condo in the Greektown Danforth area. We are building a 12-story condominium here with approximately 355 residential units. Now, this project expected completion value is at approximately $386 million. The total raise that we need for this project is $30 million. Now, once we complete the $30 million raise, we will close that project. Any future investors are not eligible to invest anymore, and that is part of that close-ended style that we have here. So one more time, unlike the funds, once we've finished raising the capital, investors can no longer invest and they will be able to receive their initial investment plus their profits at the end of the project. Now, for this project, we have a time frame of approximately 5.2 years. And at that means that you'll be completing in approximately 2029. Now, what you can expect as an investor is a 20% net annual return. Now, if you add that up, right, with a 20% per year return on a 5-year project, you're getting more than 100%. So we're targeting to double investors' capital here. The minimum investment is at 25,000, so just like the apartment fund, but you can also use your registered accounts, RSPs, LIRAs, all of them are welcome. For the people that might not be familiar with the process of a development, I'm going to share with you a timeline. And there's usually how all developments go. There's 5 stages to a development. There's the acquisition phase where you acquire the land where the project will be constructed. Then you go into the site plans and approval. So essentially you are getting all the zoning approvals, right? The site plans, all of that gets completed. Usually takes the longest amount of time. So right now we've already acquired the land. It is under Equiton's possession, but we are currently in that process of site planning and approval. We're expecting to be in the pre-construction phase by 2026 and also start the construction phase right after that. Ultimately, we're looking to hand off the keys and occupancy at Q1 of 2029. So that is when investors can expect their capital back as well as their profits. For anybody that's not familiar with the Greektown area, I'm going to show you a map, right? And this is really highlighting the value that this project brings. It is a very unique project because whenever you're going into a development, there's 2 things that people look for: accessibility and lifestyle. Now, when I talk about accessibility, people usually look at how close is it to a major highway, right? How close is it to public transportation? And for the most part, especially if you're building a condominium, you usually have to choose either being close to a highway or close to public transit, like a subway station. With this development, you're getting essentially both of those things. It is right at the DVP, so very close to a major highway, and it's also a couple minutes away from the Broadview subway station. So you get the best of both worlds on that end. And why we really like this project is because the proximity to downtown Toronto is only approximately 15 minutes. So you are still getting great amenities, a great location, but you're not getting the busy area that is downtown, right? So you're still getting a lot of greenery around it, a lot of accessibility to other amenities without having to be downtown, right? And a lot of people appreciate that. So that's really the highlight of this development, right? There is a lot more that I can get into detail, but I'm going to keep it very high level for you. The main thing that I want all the audience to take away from this presentation is that we have a suite of offerings that could be pleasing to all types of investors, whether it's somebody that's getting new to the space, whether it's somebody that is experienced, somebody that has a high time horizon, somebody that has a low risk tolerance. We have a little bit of everything. So if you are interested, this could definitely be an opportunity for you. At this point, now that I talked about the 3 offerings, I think I'm going to open it up. Maybe Harshit, if you have any questions or any of you members want to ask anything, feel free. We'll be able to answer any of your questions as well.
Thank you, Sebastian. That was a nice presentation. It was very helpful. I hope our clients were able to get some information, but anybody have any questions, please drop down in the chat menu down so that we can get the questions and we can get it answered. But Sebastian, I would like to have like a few questions. Like, I wanted to know for our clients, like, what is the risk involved in this investment and how easily they can exit the investment?
Great question. So depending on the investment, right, they all have a different risk profile, right? On the most conservative side that we have the apartment fund, right? Very consistent, straightforward. On the high risk side, we would see the development. Now, when can you exit the investment or how could you exit the investment, right? So we're talking about the funds. it is much more accessible. I did mention there's a 3-year holding period. So if you are within that 3-year mark, if you're comfortable with a 3-year holding period, this could be a great option for you. However, you're not locking in your funds for the full 3 years. For whatever reason, if there's an emergency or need to have access to your capital, you can still withdraw from your investment. So that's still a possibility. However, if it's done before that 3-year mark, you would face an early redemption fee. Depending on the time and the investment, it could be, but on average, it is a 3% fee. So what I wanted you to take away with that is that it is still accessible in the funds. However, if it's done before the 3-year mark, you will be facing a penalty. The other thing to note is what we ask from you is a 30-day notice. That is all we ask from you. If you do want to redeem, it is a 30-day notice so we can get it processed. Now, with the development side, like I mentioned before, this is the project where you're not going to have liquidity. You have to understand that you're getting into a hard hold, essentially. If you want to withdraw, unfortunately, that is not an option. So be conscious of that. For you to take advantage of these great returns, which are targeting that 20% per year, you have to be okay with locking in your funds until the end of the project. That is when it will be completed and all profits will be paid off.
Right. So for this Equiton Residential Income Fund Trust, the minimum entry point at this point is $10,000, I believe.
That is correct. It is $10,000 for the Income and Development Fund. There was an update to the fund as it continues to grow, right? We want to make sure that all investments can impact that fund. And that is the reason why we have it at a $10,000 minimum. Now, it's still very approachable, right? Usually in the private sector, the minimums are much higher. Very few firms have a $10,000 minimum offering. So that's why we've kept it there to make it accessible to all people, really.
Right. And for these development funds, the minimum is different, right?
So just to break it down, the apartment fund is 25,000, the income and development fund is 10,000, and the development is 25,000. And like I mentioned, they are all eligible to be used with registered accounts as well.
That's good to know.
Perfect. Any other question? One more time, I do want to highlight that if this was something of your interest, right, feel free to contact Harshit, and that way we can set up a one-on-one, a much more intimate meeting. That way I get to know what you're looking for and ultimately see if Equiton and their offering is something that suits your needs as well.
No, of course, yeah, guys. If you have any questions, let us know or let me know later on and we can discuss further and answer your questions. But I personally feel that it's a good opportunity where our investors who are on the sidelines and not investing in the real estate in this market, they can invest their registered funds and still get decent double digits growth, which is good for them.
Of course.
Yeah. So that's a good opportunity here. Well, we don't have any other questions. Anything you want to add, Sebastian, before we let
go?
Just
hopefully I appreciate one more time. I'm going to thank everybody for coming into the meeting today, taking time out of your day. If this is something that you might see of interest or want to have just a more of a personal conversation, there's my contact information, but also please feel free to reach out to Harshit. And yeah, I'll be here to assist you. What I can provide to you is a very, very close and intimate investment relationship that we have here with our clients, right? So look forward to connecting with any of you if that is something of your interest. And hopefully we'll get to do one of these sessions again, Harshit. I appreciate you setting this up as well.
No problem, Sebastian. Thank you for your time. I appreciate everybody's time. Have a good evening, guys, and we'll chat soon. Thanks. Bye for now.
Take care.